Well, after hearing from Ottawa yesterday, that fiscal deficits will be higher in the years to come, Canadian investors also heard from Bank of Canada's Governor Tiff Macklem today that fighting inflation half-heartedly would be a mistake. For more perspective on the messages from both the federal government and the central bank and what they mean for markets, joining us now is Michael O'Brien, Managing Director and Head of the Core Canadian Equity Team at TD Asset Management. Michael, thanks so much for joining us this afternoon.
It's great to be here.
So we did hear from the federal government that those deficits are going to be larger in years to come, not in this current year, but some new spending is going to increase the deficits in the years to come. What do you think investors are thinking about when it comes to the federal deficits and the spending that the government is continuing to do?
Well, I think when you look at the numbers that sort of make the front page of the news, and $1 billion here, $1 billion there, starts to add up.
Yeah.
However, I think if you step back and put it in context, Canada is roughly a $3 trillion economy. So an extra $20 billion over 6 years, not to be apologetic for the government, but an extra $20 billion over 6 years in a $3 trillion economy, to me, that's not excessive spending. So I would actually say, I was pleasantly relieved that they demonstrated some restraint, because there's clearly a lot of demands on this government to spend, a lot of a very long wish list, them and their partners, the NDP, with their supply agreement. So I think the fact that they resisted that temptation and stuck to a relatively targeted, narrow list of priorities, that to me, that was actually reassuring.
There was one part that jumped out to us about the rule around what pension funds can invest, or the amount that pension funds can invest in Canadian companies. This 30% rule, they're looking at exploring the possibility of doing away with that rule, so pension funds would be able to invest more than that 30%. What do you make of that? Do you think that that is a good strategy if the federal government is trying to get those pension funds to be thinking about investing in this country more than perhaps internationally?
Well, I'm going to be honest about this. This isn't my area of expertise, but my understanding is this is something that the pension funds have wanted for some time, this flexibility. I think there have been discussions going back years on this matter. And so it's really a trade-off between the original purpose of this rule, which prudential considerations around should pension funds be active investors as opposed to passive investors, and also concerns about excessive concentration in a single investment. I would say if you look at our largest pension funds, which are some of the leaders around the globe in terms of their sophistication, I think they've demonstrated pretty good fiduciary stewardship, and so that's not high on my list of worries. Where I find it a little bit intriguing is if you think back, there once was a time that, you and I might be able to remember, I certainly can, where, there were actually foreign content limits on our RSPs and other pensions. Those were done away with years ago. That allowed these pension funds to really diversify their assets globally. We're almost in a situation now where maybe they've gone a little bit further than the government desires and, in de-emphasizing Canadian exposure. And so there is a role to play for that long-term patient capital, the type of patient capital that a pension fund can provide. So, there may well be some merit to this in terms of attracting money back into some of these Canadian areas, which potentially have been ignored.
Another part of the federal, the economic statement, rather, was the mortgage charter. And there were a few points from that. So some relief on fees if people are in, a challenging situation, the banks needing to reach out in advance of somebody renewing their mortgage by a few months to make sure that they're thinking about what they need to be doing and that they're going to be all, prepared for what they might need to be paying down the road when they do renew. How much of an impact do you think some of the efforts that the federal government outlined will end up having on the banks? And I do think that some of them were already out there. There was already a knowledge that this was something that the government wanted the banks to be thinking about and doing already. But what do you think the impact could be? Well,
I think it's an example of the government, to steal a phrase from Theodore Roosevelt, they were using their bully pulpit here to try to, using moral suasion in a sense, as opposed to being too intrusive in terms of establishing hard rules. A lot of what they mention in this mortgage charter seems to be best practices, like reaching out to your customers 4 to 6 months ahead to, start considering potential sticker shock. That just seems to me like a sensible thing to do. And like you said, I think that's been underway for some time already. So by and large, I don't think that this is going to have a huge impact on the banks. That said, the devil's in the details. And so, this has been out 24 hours. Some of these things haven't been totally flushed out. I saw some concerns about various parts, various aspects of it today. But I think by and large, this is not something that's unexpected. And it's not something that the banks are unprepared to deal with.
I'm curious also to get your thoughts about what we heard from the Bank of Canada Governor Tiff Macklem today. He seemed to be talking about how interest rates are as high as they need to be in this country in order to get inflation down to that 2% target. What do you think of that notion? What do you think investors should be thinking about that notion?
Well, I find that encouraging. I think there's an interplay here between the fall economic statement 24 hours ago and, where Mr. Macklem and the rest of the Bank of Canada is at today, which is we're at a junction in time where fiscal and monetary policy need to be working in tandem. And I think that's why I said at the beginning I was relatively encouraged that the government was, showed fiscal restraint. I think the single biggest thing the bank, the federal government can do right now is not try to do too much and allow the Bank of Canada to finish its job. Because I think right now, the focus today has been on fiscal policy. The real focus going over the next, 6, 12 months for Canada is going to be on monetary policy. And it's really going to be a question of, can the Bank of Canada bring inflation down quick enough to allow monetary policy to pivot? Because when you look at the wave of mortgage renewals coming in 2024, 2025, 2026, it's obvious that Canadians are going to need help. Households are going to need help getting through that. The single biggest lever to pull, frankly, is lower interest rates. And so if the Bank of Canada can put itself in a position where it's comfortable enough with the inflation trajectory and where federal and provincial governments aren't sort of working at cross purposes, it'll make their job much easier.